All right, welcome back to Journey to XRP. Settle in, because what I'm about to walk you through today is not comfortable, not popular, and definitely not what most people in crypto want to hear right now. But it is necessary. This is one of those videos that a year from now, you're either going to remember watching or you're going to wish you had, especially as we move closer to 2026. Let me start by saying this clearly because it needs to be said up front. The 4-year crypto cycle that everyone has been worshiping like gospel is done, finished. Throw it out the window. If you're still anchoring your expectations to that model, you're not being disciplined, you're being lazy. And that laziness is exactly why so many people feel exhausted, confused, and borderline defeated after what 2025 turned out to be. A year that was supposed to be a bull run, but for most people didn't feel like one at all. A lot of you came into this year thinking this is it, this is where everything finally explodes, and instead you got chop, frustration, fake breakouts, and long stretches where nothing seemed to work. Some of you are genuinely questioning whether you missed it. Others are quietly wondering if crypto even works the way you thought it did anymore. And a few of you are probably closer to giving up than you'd ever admit publicly. If that's you, listen carefully, because the problem was never that you were early or late. The problem is that you were focused on the wrong cycle. Crypto doesn't move because of dates on a calendar. It doesn't move because of halvings by themselves. And it definitely doesn't move just because Twitter decides it's bullish season. Crypto moves for one primary reason, and that reason is liquidity. Always has been, always will be. And if you don't understand where liquidity comes from, how it expands, and when it contracts, you will keep getting emotionally whipsawed every single cycle. What most people don't realize is that the so-called 4-year cycle only ever worked because it happened to line up with a much bigger force in the background, the global liquidity and business cycle. The moment those two started to decouple, the model broke. And that's exactly what we're living through right now. This is why 2025 felt so strange. This is why the moves didn't have follow-through. This is why rallies faded faster than expected. And this is why simply waiting for the next leg up without context has been such a painful strategy. The market wasn't broken, your framework was. In this video, I'm going to show you why the next real expansion phase for crypto is not a 2025 story, but a 2026 story. And no, this isn't hopium, and it's not based on vibes. It's based on data, history, and one economic indicator that has a far tighter relationship with Bitcoin, XRP, and the broader crypto market than the 4-year cycle ever did. We're going to talk about liquidity. We're going to talk about what the Federal Reserve is already doing, even if they refuse to call it what it actually is. We're going to talk about why the market has been starved, why that starvation is nearing its end, and why the conditions that produce real sustained bull runs are not here yet, but are forming. And here's the part that might sting a little. If you've been emotionally checking out because price hasn't done what you wanted on your timeline, you're playing this game backwards. The market doesn't reward impatience. It rewards understanding. And understanding starts with accepting that narratives change when structure changes. Right now, most people are still arguing about whether we're early, late, mid-cycle, or post-cycle, when the truth is much simpler. We've been in a liquidity-constrained environment, that's it. No amount of optimism can override that, no amount of memes can fix that, and no influencer yelling about targets can force capital into the system before it's ready. But here's the key thing you need to hear before we go any further. Liquidity cycles don't end quietly. They turn decisively. And when they do, the people who stayed focused on the mechanics instead of the noise are the ones who benefit. So if you felt lost this year, good. That means you're paying attention. If you felt frustrated, even better, because frustration usually shows up right before clarity. What matters now is not whether you believe in XRP or Bitcoin or crypto as a whole. What matters is whether you're willing to update your framework, because once you see what actually drives these markets, you stop chasing moves and you start positioning for them. Now that we've reset the framework, this is where things get uncomfortable for a lot of people, because once you understand how liquidity actually enters the system, you realize why 2025 played out the way it did and why the market couldn't simply will itself into a bull run. Let's talk about the Federal Reserve, because whether people like it or not, this is where liquidity begins and ends. Over the last couple of years, the Fed has been very clear about one thing. They were tightening financial conditions. Rates were high, balance sheets were shrinking, and liquidity was being pulled out of the system through quantitative tightening. That is not a neutral environment for risk assets. Crypto doesn't thrive in restraint. It suffocates in it. Now, here's where people get confused. They hear headlines saying the Fed isn't doing QE, and they stop thinking. But markets don't move on labels, they move on flows. And if you've been paying attention, the Fed has already started laying the groundwork for renewed liquidity, even if they refuse to use the politically loaded words. We've already seen interventions in the repo market. We've already heard them talk about what they conveniently call treasury management, short-term T-bill purchases, balance sheet backstops, temporary facilities. Call it whatever makes you feel better. The function is the same. When the system starts to creak, the Fed steps in to keep it from breaking. That's not speculation, that's precedent, and this didn't happen in a vacuum. We've already had multiple rate cuts delivered in 2025, and those didn't come because everything was suddenly fine. They came because things weren't fine. Jobs numbers were revised, growth expectations softened, stress started showing up where most people don't look. Private credit, private equity, commercial real estate. The cracks didn't start in crypto. Crypto just felt them first. Here's the mistake most retail investors make. They think rate cuts immediately equal bull markets. That's not how this works. Rate cuts are a response to damage, not a celebration of strength. They signal that something has already gone wrong under the surface. And in 2025, those cuts were late and limited. They weren't enough to restart liquidity expansion. They were defensive, not stimulative. That's why this year felt like running on fumes. Every rally ran into a wall. Every breakout lacked follow-through. There was no sustained bid because there was no sustained liquidity. You can't build a real bull run on hope while the central bank is actively draining capital from the system. This is also where a lot of people misunderstand QE. QE doesn't arrive because markets ask nicely. It arrives because the system forces it. When refinancing risks pile up, when credit markets tighten too much, when something threatens to cascade, that's when policy flips. And history shows us that once the Fed pivots from restraint to support, it doesn't do it halfway for very long. The reason 2026 matters is not because it sounds good or fits a narrative. It matters because the conditions that justify large-scale liquidity expansion are forming. The Fed is boxed in. High rates are not sustainable forever. Balance sheet reduction has limits. Political pressure, economic pressure, and market pressure all converge at the same point eventually. And here's the key insight most people miss. Markets don't wait for QE to be announced on a podium. They move when expectations of liquidity shift. They move when forward-looking indicators tell institutions that the environment is about to change. That's why obsessing over dates is useless. You want to understand signals, which brings us to the most important part of this entire discussion and the indicator that consistently shows when those liquidity shifts are happening beneath the surface. Not headlines, not vibes, not cycles people memorized from the last decade. An actual business cycle metric that has quietly tracked major crypto tops and bottoms with uncomfortable accuracy. Because once you see how that indicator behaves and where we are relative to it right now, the idea of a 2026 expansion stops sounding like optimism and starts sounding like preparation. Now, this is where the conversation stops being opinion-based and starts becoming evidence-based, because instead of guessing when liquidity might return, we can actually track when it has returned in the past. And the indicator that does this far better than any four-year cycle ever has is the ISM Manufacturing PMI, the Purchasing Managers Index. This index doesn't care about crypto narratives. It doesn't care about halvings, ETFs, influencers, or sentiment. It measures real economic behavior by surveying purchasing managers across hundreds of U.S. manufacturing firms. These are the people placing orders, managing inventory, hiring workers, and responding to demand in real time. When they're expanding, liquidity is flowing through the system. When they're contracting, liquidity is drying up. It's that simple. The number itself is straightforward. Above 50 means expansion. Below 50 means contraction. Around 50 means stagnation. But what makes this indicator powerful is not the number, it's the timing. Because historically, major crypto bottoms have formed during deep contraction phases, and major crypto tops have formed after prolonged expansion phases. Not instantly, not perfectly, but consistently enough that ignoring it is reckless. Let's walk through this without nostalgia or cherry picking. In early 2016, the PMI bottomed in the high 40s, deep in contraction. At that exact time, Bitcoin's market cap was insignificant by today's standards, single-digit billions. Nobody cared. Nobody believed. Liquidity conditions were miserable. But that PMI low marked the turning point. As the index recovered and moved back toward expansion, capital slowly re-entered risk assets. The result was the 2017 bull market, with Bitcoin eventually peaking near the end of that expansion phase. The PMI itself topped shortly after crypto did, not before. That lag matters. Fast forward to 2020. PMI collapsed into the low 40s during the global shock. That contraction aligned with one of the most violent crypto sell-offs in history. Bitcoin's market cap was crushed, sentiment was broken, and once again, that PMI low marked the bottoming process. As liquidity returned through stimulus, expansion followed. Crypto didn't wait for perfect conditions. It responded as liquidity expectations changed. The result was the 2021 bull market, with crypto topping after PMI had already been elevated for months. Then came 2022, PMI slipped back below 50, contraction returned, liquidity tightened, and crypto entered a brutal bear market. This wasn't mysterious. It wasn't manipulation. It was macro. Bitcoin bottomed late 2022, slightly ahead of the PMI bottom in mid-2023, which is exactly what you'd expect from a forward-looking market. Now look at where we've been recently. The PMI has chopped around the 50 level, briefly popping into expansion and then slipping back into contraction. That's not a healthy expansion cycle. That's a stressed system trying to stabilize without enough fuel. And that explains almost everything people are confused about right now. Why rallies fail, why momentum dies, why conviction keeps getting tested. This also explains why the 4-year model broke. That model assumes predictable liquidity waves. But when structural forces change, ETFs, balance sheet policy, geopolitical constraints, the calendar stops being the driver. Liquidity conditions do not care what year it is. And here's the most important takeaway from this entire section. Crypto does not begin its strongest moves during contraction. It begins them when contraction ends and expansion returns, not when the PMI is already screaming hot, but when it transitions. That transition phase is where positioning matters most. Right now, we are not in sustained expansion. That's the hard truth. But we are also not in deep contraction. We are in the late stages of tightening with clear pressure building for a reversal. That's not bullish yet. It's preparatory. This is why expecting a full-blown bull run in 2025 never made sense if you were watching the data instead of the calendar. Liquidity wasn't there, PMI wasn't there, and without those, price moves are fragile. So when people ask, why hasn't crypto really taken off yet? The answer isn't complicated. The engine hasn't turned over. It's been cranking. The real question now isn't whether this indicator matters. History already answered that. The question is, what happens when expansion actually returns in a system that now includes ETFs, institutional rails, and assets like XRP that are positioned for regulatory clarity? Because when that switch flips, the market won't care how tired people are. It won't care how many gave up early. It will move based on conditions, just like it always has. And that's where the story starts to get very uncomfortable for anyone still stuck arguing about cycles instead of watching the signals. Now, this is where we have to zoom out and talk about why this cycle is fundamentally different and why applying old playbooks to new market structure is how people get left behind. Because even if you fully accept the liquidity argument, there's still a missing piece that explains why timing has felt off, why expectations were distorted, and why 2026 keeps showing up as the inflection point instead of 2025. That missing piece is market structure, specifically the introduction of spot Bitcoin ETFs and what they changed under the hood. For the first time in crypto's history, Bitcoin became directly accessible to institutional capital through regulated traditional financial rails. That's not a narrative shift, that's a structural one. And when structure changes, behavior changes. This is exactly why Bitcoin did something it had never done before. It pushed to a new all-time high before the halving. That single event was the clearest confirmation that the old 4-year model had been disrupted. People tried to explain that away as hype or retail frenzy, but the data didn't support that. ETF inflows were steady, persistent, and largely happening through over-the-counter channels. At the same time, Bitcoin balances on centralized exchanges were declining. That means supply was being absorbed without public order books lighting up. Price moved not because of speculation, but because of structural demand. This matters far beyond Bitcoin. The argument that future XRP ETFs wouldn't matter because of OTC execution completely falls apart when you look at what just happened. OTC doesn't mean no impact. It means the impact happens quietly, without the emotional noise people are used to watching. Liquidity doesn't need drama to work, it needs pathways. Now combine that structural change with what we discussed earlier. In 2025, despite ETFs being live, the broader system was still liquidity constrained. Quantitative tightening was still active. Rate cuts were delayed. PMI failed to sustain expansion. That's why price strength appeared and disappeared so quickly. The engine had better parts, but it was still starved of fuel. This also explains why XRP has felt particularly frustrating to hold. You have an asset that is increasingly aligned with regulatory clarity, institutional infrastructure, and real-world financial use cases, but operating in an environment that hasn't yet allowed capital to flow freely into risk. That's not a failure of the asset. That's a mismatch of timing. And this is where 2026 starts to matter in a very practical way. When liquidity expansion aligns with regulatory clarity, markets don't move incrementally, they reprice. And that doesn't mean straight lines up. It means the range itself shifts higher. And historically, that's when assets that spent years being ignored or underestimated move the fastest. For XRP specifically, the setup is binary in a way most people don't fully appreciate. Without liquidity, narratives stall. With liquidity, catalysts compound. Regulatory clarity, institutional access, tokenization narratives, ETFs, on-chain utility, none of those matter in isolation. They matter when capital has permission to move. That's why focusing on price today is a distraction. XRP drifting below key psychological levels doesn't tell you where it's going. It tells you what conditions are missing. And those conditions are not permanent. The mistake people make at this stage is assuming that patience means passivity. It doesn't. It means preparation. It means understanding what would invalidate your thesis and what would confirm it. If PMI fails to re-enter sustained expansion, if liquidity support is delayed indefinitely, if regulatory progress stalls, those are real risks. Ignoring them would be irresponsible. But if expansion returns, if liquidity support accelerates, and if the regulatory environment continues to improve, then the revaluation doesn't happen slowly. It happens because the market realizes it mispriced the future. That's the phase where conviction gets tested hardest, right before it's rewarded. And before anyone misinterprets this as blind optimism, the final thing we need to do is ground all of this in reality, what this actually means for positioning, expectations, and responsibility as market participants. Because understanding the setup is only useful if you know how to act on it without deluding yourself. So let's bring this all together, because if you followed the logic up to this point, you should already see why this conversation has never really been about price targets, timelines, or emotional conviction. It's been about conditions. And markets don't move because people want them to. They move when the environment allows them to. The biggest mistake people make at this stage of a cycle is confusing understanding with certainty. Nothing we've discussed guarantees outcomes. What it does is frame probabilities. Liquidity expansion has historically been the prerequisite for sustained crypto bull runs. Business cycle indicators like PMI have historically aligned with major turning points. Structural changes like ETFs have altered how capital enters the market. Regulatory clarity changes who is allowed to participate. When those forces align, markets tend to reprice aggressively. When they don't, they stall. That's the reality. No hype, no magic, no shortcuts. What makes 2026 stand out is not that it sounds exciting, but that it's the first window where these forces plausibly converge instead of fighting each other. Tightening gives way to easing. Contraction gives way to expansion. Defensive policy gives way to support. And markets, which are forward-looking by nature, begin to reflect that shift before it becomes obvious in headlines. For XRP specifically, this is where discipline matters. Assets tied to infrastructure, liquidity, and regulation don't behave like memes. They underperform when conditions are wrong, and they move fast when conditions flip. That creates emotional pressure. It makes people question their thesis at exactly the wrong time. That's not accidental. That's how markets transfer conviction from the impatient to the prepared. But here's the line you should never cross: confusing preparation with blind faith. If liquidity fails to expand, if business cycle indicators roll over again, if regulatory progress stalls or reverses, then the thesis weakens. Period. Ignoring that would be reckless. Updating your view when facts change isn't weakness, it's competence. The goal is not to be bullish or bearish. The goal is to be aligned with reality. This is also why chasing narratives late is such a dangerous habit. By the time something feels obvious, the risk-reward has already shifted. The people who benefit most from cycle transitions are rarely the loudest. They're the ones who understood the setup early, sized risk appropriately, and didn't let short-term frustration force long-term mistakes. If there's one takeaway you should walk away with, it's this: stop asking when price will move and start asking what conditions are missing. That single shift in thinking changes how you experience markets entirely. You stop reacting to every candle, you stop being shaken by every delay, and you start evaluating information instead of absorbing noise. None of this means sitting still forever. It means knowing why you're positioned the way you are, what would make you change that position, and what time horizon you're actually operating on. Traders and long-term holders can coexist, but only if they're honest about which one they are. And finally, this needs to be said clearly: everything discussed here is analysis, not instruction. Markets are uncertain, liquidity cycles can shift, policies can change, assets can underperform expectations. This is not financial advice. You are responsible for your own decisions, your own risk management, and your own research. Do your own due diligence, question every assumption, including the ones presented here, and never allocate capital you can't afford to lose. If you do that, you don't need certainty, you need awareness, because markets don't reward belief, they reward preparation.